Allow me to issue and control the money of a nation, and I care not who makes its laws. Mayer Amschel Rothschild, father of international finance. Money, money, money. You either have it or you sell your whole life to get it. Money is everywhere. It's in the chair you sit in. It's in the cell phone or computer you're using to watch this video. It's in the napkin you use. But have you ever thought about where the money comes from? Who creates it? How is it being created? And who controls it? These questions seem to be simple, but even most economics students and teachers don't know how money is created today. The way our money is created is the main reason that you can't afford to buy a house and find a good job. It's the root cause of major problems. That is the main reason there's a lot of complexity around money to hide the truth. In our modern economy, we have two kinds of money: paper money and electronic money, which is the most commonly used money today. Electric money is the numbers you see in your account or the payment card you use when shopping. If we think of money in terms of our daily use, there doesn't seem to be much difference between these two kinds of money. If you buy a cup of coffee, it costs the same, regardless of whether you pay with a payment card or cash. The difference between the two seems to be merely a matter of convenience or preference. If, however, we ask, how is money created? Then we will see that there is a huge difference. Let's start with paper money. Paper money is created by the central bank in the form of paper banknotes or coins. You can read that on the banknote. If someone else tries to create it, they will go to jail for counterfeiting. Many people believe that the central bank is the main organization that creates the majority of our money. But in reality, only 3 to 5% of the total money supply is paper money created by the central bank. And the remaining 95 to 97% is electronic money created by commercial banks. Electronic money is very tricky. Many people think that electronic money is just the electronic version of paper money. However, that's not true. Electronic money is created by commercial banks when they issue new loans. Imagine that you go to a bank to get a loan for $10,000. This loan will rarely be paid out in cash. When you spend this electronic money, you simply transfer it from your account in your bank to someone else's account in his or her bank. And in this process, the electronic money is not transferred into paper money and then transferred back into electronic money. When a bank issues a loan, let's say $1 million, it means the bank simply creates and adds $1 million to the total money supply in the economy. Maybe right now you are wondering, where did the bank get this $1 million to lend in the first place? Is there an army of grandmothers and grandfathers who have put their entire life savings into the bank, and the bank is using this money in order to make a loan for $1 million? Of course not. They just typed numbers into your account. Step 1, you sign the loan. Step 2, bank types the numbers into your account. 95 to 97% of our money supply is created in this way. I'm sure some of you are saying, come on, how's that possible? There's no way the bank simply types numbers into my account when I borrow money. You might not believe the things mentioned in this video, but here's a quote from the Central Bank of England. Commercial banks create money in the form of bank deposits by making new loans. When a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it does not typically do so by giving them thousands of banknotes. Instead, it credits their bank account for the size of the mortgage. At that moment, money is created. You get excited about all these new smart ways of paying for things, such as internet banking, payment cards, and smartphones. But we have to remember the price we have paid for this convenience. We have essentially privatized the creation of money in our society. I'm sure you've heard the saying, money is power. If money is power, then what does it mean to give the creation of this power to banks, to profit-seeking private organizations? I hope you're starting to see why it's a big issue to let the banks create money. First of all, let me tell you that I don't hate banks. I'm not saying that banks are evil or bankers are greedy. The main problem is that we have given too much power to the banking industry. We've basically allowed banks to combine two vital processes, which are money creation and money lending. As a result, when banks lend money, they are creating money. It's very important that you understand this part because it has a direct impact on you. This is the main reason you can't afford to buy a home and find a good job today. Just like normal private businesses, banks also want to maximize their profit and minimize their risks, which means they have incentives to lend money to certain sectors that are less risky. And you know what the sector is that has a lower risk for banks? Real estate. For banks, it's risky to lend money to a small business because there's a high chance that it will go bankrupt. But mortgages have collateral. If the borrower can't pay, the bank will take the property to cover its losses. Since it makes sense for banks to lend money for mortgages, newly created money floods into the real estate market instead of other sectors that society needs, such as renewable energy, the creation of new businesses, schools, hospitals, etc. From the surface, it may seem like society benefits from cheap mortgages, but we don't. Imagine that on New Year's Eve, Santa Claus comes and doubles everyone's money. If you have $10,000 in your account, Santa Claus makes it $20,000. Suddenly, everyone feels rich and rushes to shops to spend it. And you know what happens next? Within a few days, prices will rise. Since prices rose, no one is going to benefit from the sudden increase of wealth. Having access to cheap mortgages works in a similar way. House prices keep getting higher and higher. The common belief is that houses are expensive because of immigration, the increase in population, and the decrease in the amount of newly built homes. Even though these factors can have an impact today, these are not the main reasons for such high house prices. The biggest impact comes from the increase in mortgage lending. For example, in the 10-year period between 1997 and 2007 in England, 40% of newly created money went to the property market, 37% to financial markets, 10% to credit cards and personal loans, and only 13% went to business lending that benefits the economy. That is why on average every year home prices are going up 7.7%, while salaries are only rising by 0.8%. These numbers are for the UK, since the author of the books I have used to create this video is from the UK, but the situation is similar in most countries. As you can see, almost 80% of the money went to non-productive sectors that do not benefit the economy and job creation. As a result, new jobs are not created, and unemployment goes up. For example, in Italy, 40% of youth under 25 are unemployed. In Spain, it's 56%, and in Greece, it's 60%. This is a massive waste of human resources who want to be doing something useful, but can't, simply because of how money is created and distributed in the modern monetary system. So if you want to solve the housing problem and unemployment, you need to look at how our money is created. One of the common questions I get is this: if banks have created so much money, then why don't we have inflation in the economy? As you just saw, a big portion of the newly created money does not flow to the economy. It flows to the property market and financial markets. Inflation is created in the direction where the money flows. That's why home prices and stocks are going up while the rest of the economy moves like a turtle. In the past, one member of the family was working, and he was able to support the family, plus buy a house. Today, both partners are working, but despite that, they can't afford to buy a house. Many young families who qualify for mortgages barely pay their regular expenses and mortgage payments. What's going to happen if interest rates go up? Well, the bank will kick them out and take their homes. But here's the most important question that no one asks. What did the bank do in order to earn the rights to take away the homes of these families, except by typing numbers on the screen? Therefore, mortgages are the best-selling product on the bank's shelves. And why is it a bad idea to let the banks create money and control it? Instead of getting excited about all these new electronic ways of payment, wait for a second and ask who really benefits from it. Since everything is electronic, banks are closing their branches. They are closing ATMs. They don't need to hire people. And they don't need to buy bulletproof cars to carry the money. These all translate to lower costs for banks on top of the massive profit they get from creating money out of nothing. I would like to talk about 3 more problems with our banking system, which are inequality, instability, and accumulation of power in the hands of a small group of people. First, let's talk about instability. The way banks lend money is very similar to an umbrella shop that sells umbrellas when the sun is shining, but when it starts raining, the shop closes. When the economy is booming, stocks and house prices are going up, the banks are very keen to create new money and lend it to the economy. This, however, has the effect of inflating the prices in the economy even more. As we know, ultimately, these bubbles burst and crises happen. When the crises happen, the banks become reluctant to create money and lend it to the economy, and this in turn worsens the situation. Banks have an incentive for creating money when we don't need it and hold it back when the economy actually needs it. The second problem is inequality. As we all know, when we borrow money, we must pay interest, and we can think of this interest as a kind of tax on the money. This tax, however, works opposite of normal taxes. In the normal tax system, the higher you earn, the higher the taxes you pay. However, in the banking world, the more you earn, the richer you are, the less taxes you pay. In other words, the richer you are, the more assets you have, the lower interest you pay to the bank. On the other hand, if you are poor and have little money, you must pay a high interest rate. The way money is created is a key explanation for the inequalities in our society and why it keeps rising. The same inequality applies to countries as well. We see some countries paying high interest rates and thereby becoming poorer and poorer, and we see other countries getting richer and richer and paying lower interest rates. The third problem is about power. If you can decide when to create money, if you can decide how much new money to create, if you can decide the interest rate to charge, if you can decide for what purpose to lend the money, then you have enormous power over everyone else. And this power is not only over the economy, but over the society. By privatizing the creation of our money, we have essentially handed over a very vital power to the banks. That's why many politicians today appear very impotent, because crucial decisions are not made in Parliament. They are made in the boardroom of major private banking corporations. We need to start questioning the power we have given to the banks. We need to start questioning if we really need a big banking industry, while other sectors such as healthcare, schools, and small businesses suffer. One of the common things I hear a lot is that debt is bad, but money is good. People want the money but not the debt, but they don't understand that it's not possible. In the current system, money is debt. If we want more money, we must go into more debt. If nobody went into debt, then we would not have any money in the economy. If there's no money, then spending will go down. And when spending goes down, basically the economy goes down. You hear on TV politicians talking about paying off the debt and living debt-free, but they don't realize how ridiculous they sound when they make these statements. Unfortunately, most people believe them because they don't understand how money works. Money is something we spend our whole life earning. We use it every day, but we're not educated about it. People don't want to talk about it. They think it's taboo. They think money is bad or money is evil. Money is just money. It's neither good nor bad. Saying money is evil is like saying pizza is evil. If you'd like to learn more, then check out the book titled Modernizing Money by Ben Dyson and Andrew Jackson. Most of the information you heard in this video came from that book and the speeches given by the author Ben Dyson. The link will be in the description of the book. Thanks for watching.